When markets fall, most investors focus on the wrong threat. The market is not what destroys long-term wealth in a downturn. The response to it usually is. In this video, I break down why human instinct is hardwired to make the wrong decision during market turbulence, and what the data shows it actually costs over time, and the professional framework for what to do and what not to do when volatility hits your portfolio. The problem during market volatility is not information. Most investors understand intellectually that markets recover. The problem is that the brain does not respond to a falling portfolio the way it responds to information. It responds the way it responds to a physical threat. Loss registers differently from gain. Research in behavioral finance consistently shows that the pain of losing a given amount feels roughly twice as intense as the pleasure of gaining the same amount. This is not a character flaw. It is a feature of human cognition that served a purpose for most human history. It does not serve a purpose when applied to long-term investment portfolio. The result is a pattern that repeats across every major market correction. Markets fall and investors feel that loss significantly. The instinct is to act, to stop the pain by selling. That action is what converts a temporary market decline into a permanent loss of capital. The cost of reacting to market volatility is not theoretical. It is measurable across decades of real data. Morgan Stanley research tracking investors over a 45-year period illustrates the gap precisely. An investor who stayed fully invested and contributed $5,000 per year from 1980 to early 2025 would have built approximately 6.1 million at an average annual return of around 12%. An investor who did the same but sold after major downturns and waited for 2 consecutive years of positive returns before reinvesting ended with roughly 3.6 million. Same contributions, same time horizon. The difference is entirely explained by the decision to exit and re-enter. And the investor who sold after a 30% drop and stayed in cash, approximately 524,000, not 3.6 million, not 6.1 million, 524,000 on the same contributions over the same time horizon. The market did not produce that gap. The decision did. And there is one decision during a downturn that consistently improves long-term outcomes rather than damaging them. Rebalancing, buying equities when they are cheaper, and that's covered shortly. Vanguard research tracking the stock market over 50 years identifies 8 separate periods when shares fell more than 20%, 8 significant downturns, and through all of them, the overall direction was upward. A £100 investment in 1972 grew to roughly 7,500 by 2026. Markets fall, and they have always fallen. They have always eventually recovered and continued higher. The question in a downturn is not whether to stay invested. The question is whether your behavior during the fall will prevent you from capturing the recovery. When markets are in a downturn, there are 6 specific behaviors that consistently produce worse outcomes than doing nothing. Each one feels rational in that moment, but none of them are. 1. Selling to stop the loss. This converts a paper loss into a real one. A portfolio that has fallen has not permanently lost that value unless you sell. The only moment the loss becomes locked in is the moment you exit. The investors who sold during major downturns and waited for conditions to feel safer were not there for recovery. The ones who stayed were. 2. Fleeing to cash and waiting for safety. Cash preserves nominal value but loses real purchasing power while the market recovers without you. Knowing when to re-enter is the same unsolvable problem as knowing when to exit. 3. Radically cutting equities during the drop. Your allocation was designed for your actual time horizon. A market drop does not change your time horizon. Cutting equity exposure now changes your long-term risk profile in a way that's very difficult to reverse. 4. Trying to find the bottom, attempting to buy back at the lowest point is one of the most reliably unsuccessful strategies in investing. Professional fund managers with dedicated research teams cannot do this consistently. 5. Chasing daily market headlines. Financial media is incentivized to make market events feel urgent. Acting on a daily market commentary means being driven by content designed to provoke reaction, not to optimize long-term portfolio performance. 6. Missing the rebalance opportunity. During a significant equity sell-off, your equity weighting drops automatically. Not rebalancing means missing the recovery at the most attractive entry point. Disciplined rebalancing consistently improves risk-adjusted returns over time. The investors who consistently navigate market downturns without destroying long-term returns share one characteristic. They have a plan that was written before the volatility commenced, and they follow the plan rather than react to market events. Morgan Stanley tracked almost 120,000 investors with a financial plan through the COVID market crash, when the S&P 500 fell 34% in just over a month. More than 3/4 of investors who were on track to meet their goals at the market's peak remained on track at the market's bottom. Despite a 16% average portfolio decline, their likelihood of achieving their goals fell by just 2%. The plan did not prevent the decline, it prevented the reaction to the decline from compounding it. Staying the course is not passive, it is the active decision to follow a strategy designed for your actual goals, rather than a strategy designed by your emotional response to a falling number on a screen. The market will fall again, it always has. The question is not if, it is what you will do when it does. The investors who build wealth across a full market cycle are not the ones who predicted the drops. They are the ones who had a plan and followed the plan when following it was difficult. I hope you guys enjoyed the video. Don't forget to like and subscribe. I'll see you next time.